Imagine one company quietly touching almost every corner of your financial life: your retirement fund, the ETFs you buy, the mortgage markets, even the software banks use to price risk. Now imagine that company gets bigger, faster, and more powerful every year. That's not a movie. That's real. And today, we follow how it just got bigger. No, this isn't another "they control the weather" video, unless your 401k is secretly an umbrella. Pause. Then serious. Founded in 1988, BlackRock is a global asset manager. Its flagship brand, iShares, offers ETFs that investors around the world use. The company manages trillions of dollars for pensions, sovereign wealth funds, and everyday investors. It also operates investment platforms and advises major institutions. Recently, BlackRock's assets under management hit record levels, cementing its place as a financial powerhouse. Explain the origin: enormous size plus ubiquitous presence equals suspicion. Online threads, political attacks, and legitimate policy concerns all mix into a stew that looks like conspiracy to many. But size alone creates real influence, and influence invites scrutiny. If you're big enough, even your coffee order makes headlines. Introduce Aladdin, BlackRock's risk and portfolio platform used internally and licensed externally. It processes huge amounts of data and is central to portfolio decisions and risk analysis for many firms. Aladdin's scale is often cited when people say BlackRock's reach is technical as well as financial. And no, I'm not talking about Aladdin the genie, though this one still grants wishes, lower fees, tighter risk controls. Just don't ask it for stock tips at 3 a.m. State the recent factual milestone. In Q3 2025, BlackRock reported record AUM around $13.46 to $13.5 trillion and huge inflows into ETFs and private markets, illustrating rapid growth. This matters because bigger size amplifies reach and systemic effects. So, is that growth harmless? Or is it changing the rules of the game? In the next act, we pull back the curtain: tech, government ties, ETFs, and why size creates systemic power. Also, yes, there's a spreadsheet somewhere with BlackRock's name on it. Explain ETFs, low-cost, passive funds that aggregate millions of investors' money. BlackRock's iShares is one of the largest ETF families in the world, a major reason for its inflows and influence. The concentration of passive ownership changes how corporate control and voting look in practice. When big asset managers hold stakes across many companies, questions arise: who really controls corporate decisions? BlackRock votes on shareholder matters, and critics say that scale means they have outsized voice over corporate behavior. Short rhetorical question: is it stewardship or steering? Detail Aladdin as the operating system, used for risk analytics by many firms, not just BlackRock's funds. That creates informational and operational centrality, one system influencing how markets measure and respond to risk. Lay out the facts. BlackRock has been hired for advisory roles and engaged with governments on financial stability topics, and it has government relations staff in state capitals. That proximity to policymakers fuels concern about private influence in public decisions. If BlackRock were a pizza, it would be the chain that owns all the ovens, and sometimes also shows the mayor how to slice it. ESG, environmental, social, governance, investing put BlackRock in the political crosshairs. Some politicians accused major asset managers of pushing progressive agendas via corporate engagement. BlackRock's response: adjust messaging, dial back on certain stances, showing how political pressure can change behavior. BlackRock has increased private market activity and made acquisitions, e.g., HPS assets included in recent filings. Growing private market AUM changes exposure. These markets are less liquid and less transparent, increasing systemic complexity. Explain lobbying realities. Big managers invest in government relations, regulatory outreach, and public affairs. This is routine for large firms, but with BlackRock's size, the stakes are higher, and debates about antitrust and concentration have arrived at regulators' doors. BlackRock's tech, Aladdin, data, AI, aggregates information across markets. That data advantage can drive decision-making at scale and create feedback loops, fast trades, uniform risk responses, or herd behavior, which creates systemic risks in stressful markets. Describe a hypothetical flashpoint: markets in panic, Aladdin generated risk flags, many funds moving simultaneously. Now imagine that happens at scale. Who gets to press the brakes? Private market deals and complex mandates reduce transparency. For everyday investors who own index funds, the underlying flows and the role of asset managers are not always obvious, and that gap breeds both fear and misunderstanding. Short question: do you know who holds your company's voting power? Differentiate conspiracy theories, wild causal claims, from grounded critiques. Concentration of ownership, systemic risk, political influence. These are evidence-based policy issues, not necessarily cloak and dagger conspiracies. Cite working fact-check/analysis that debunks extreme claims while acknowledging real influence. You've been fed a lot. Stretch your attention span, or at least pretend to. Small pause, then continue. Reiterate the recent growth milestone: record AUM $13.46, $13.5T, big ETF inflows, private market expansion. These numbers aren't just impressive, they reshape market footprints. Give an example of how BlackRock and peers scaled back certain company meetings due to regulatory/guidance complexity, a signal of operational shifts in stewardship and engagement. Discuss arguments that massive asset managers create systemic vulnerabilities, not because they own everything, but because their actions ripple through markets. Regulators are starting to notice antitrust and systemic risk questions. BlackRock emphasizes client service, risk management, and technology solutions, Aladdin. Their filings and earnings releases frame growth as client-driven. They stress compliance and stewardship. Present their public statements as part of a balanced view. So, we've mapped the power, the tech, and the politics. But what does it mean for you? And more importantly, what can you do about it? Raise stakes, personal finance implications incoming. Advice: know what you own. ETFs are great tools, but understand their holdings, track the provider, and diversify across strategies: active plus passive, index plus bonds. Don't confuse convenience with understanding. If you care about how companies behave, learn how your fund provider votes or use shareholder advocacy-minded funds or platforms that let you direct voting. Small changes in where you place capital can compound over time. Private market allocations can be lucrative but less liquid. For most retail investors, a core of liquid, low-cost funds with an emergency buffer remains wise. Keep an eye on regulatory debates about concentration, antitrust, and passive management. These are policy fights that could reshape the investment landscape. Short example: regulators scrutinizing passive ownership's effects. AI tools like Aladdin Copilot speed decisions but can create synchronized behavior. Innovation brings cheaper, smarter portfolios and systemic synchronization. Stay informed about how technology is used by the funds you invest with. Call to agency: where you put your money reflects your priorities. Use low-cost index funds wisely, consider voting proxies, and hold fund managers accountable through client engagement or by choosing providers that match your values. So, is there a conspiracy? The more accurate answer is, there's concentrated power, growing technological centrality, and political proximity. Those three things together create real influence, and that influence just grew. But influence is not destiny. This story isn't just about a company. It's about who gets to decide how capital flows, what companies build, and what priorities markets reward. If you want to be wealthy not just in money but in control, knowledge, and freedom, start by knowing what you own, ask questions, and use your vote, with your wallet and your voice. If you found this helpful, like, subscribe, and hit the bell. I'll bring research-backed deep dives like this every week. Drop a comment: what part of this surprised you most? I'll pin the best question and answer it in the next video.